Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC TV18. I'm Vinnii Motiwala, with me Sonal Bhutra as well. Sonal, good afternoon. And we have some recent changes that have come in from SEBI. How will that impact our mutual fund industry? That's what we're going to be discussing. But what are these changes? What are we looking at now?
So let's start with what has happened. The board of SEBI has approved the amendments to SEBI mutual funds regulations for reclassification of real estate investment trusts or REITs as equity. And the hybrid classification will continue to stay for InvITs. And that is why infrastructure investment trusts for the purpose of investments by mutual funds or specialized investment funds. The market regulator has also decided to revise the incentive structure and provide incentives to distributors only for investments or inflows from new individual investors from B30, that is the below 30 cities. So what does that mean? Will it mean there is more focus on REITs by mutual funds? Will it increase the investments there? And what happens with distributor incentives as well in B30 cities? To understand more about this, we have with us Mr. Sandipan Roy, who's the Chief Investment Officer at Motilal Oswal Private Wealth, and Nirav R. Karkera, who's the Head of Research at FISDM. Gentlemen, thank you so much for joining in today. Sandipan, let me start with you first up, because now SEBI has reclassified REITs as equity products, InvITs as hybrids. How does it change it as an asset class for mutual funds? Does this improve MF flows into these categories?
Yeah, interesting. So REIT has been classified as equity, while InvITs has been retained as hybrids. I think this is a welcome change. To just put it in context, there is enough headroom for REITs allocation in mutual funds today. In US, for example, the REITs market cap is about 1.5 trillion, which is just about 2.5% of the total market cap. Compare that to India, it's roughly about 1.5 lakh crores, the private and public listed REITs that are there in the market, which is roughly about 0.3% of the total market cap. Which shows that there is huge scope for allocations for this market to develop. That headroom will translate into an MFAUM. Let's say today, out of the 75 lakh crore or 77 lakh crore MFAUM that we have, roughly about 24,000 crores is REITs, which is not even 0.5% of the MF equity AUM. Okay, can we really see an uptick in this category? The answer is yes. Now, there are two questions that need to be answered there. One, why has it not really picked up even now? Because even now, SEBI, for example, had allowed 10% in REITs and InvITs as an allocation, and within that 5% to a single issuer. But still, the max allocation that we see in various MFs, as I said, it's less than 1% as an aggregate of the AUM. And that primarily is because of two reasons. On the debt side, I think the fixed income fund managers have been reluctant to really have a big exposure in this asset class due to mark-to-market volatility. And on the other hand, on the equity side, I think the nature of this asset class is more, I would say, dividend yielding, cash flow yielding, and not a classical growth asset. And hence, the equity mutual fund managers would have also been kind of reluctant in increasing their exposures here. So this asset class largely found its space in the hybrid category of funds. So I think logically that space will actually have an improvement over the medium term in the hybrid and BAF category of mutual funds. You will see REITs allocation increasing, and also it will be employed as a defensive or a contra strategy whenever there is, let's say, a bearish outlook in the markets. Interestingly, I have a slightly different take in the very short term. I think unless grandfathering is allowed, debt mutual funds might be forced to move out of REITs, given it's in a hybrid investment and not a debt instrument. And it will become classified as an equity instrument and not debt. And hence, these debt mutual funds who are already invested, typical, income funds, etc., they may have to move out of REITs, which may lead to some bit of sell-off. Same can be the problem with, let's say, very conservative hybrid category of funds, where, let's say, already 25% equity is there, and then you had put REITs as part of the hybrid or the debt instruments, and there the reclassification will lead to them actually breaching the 25% limit on the equity allocation, and you might see a sell-off there also. So in the short term, it will be interesting to see how these debt and conservative hybrid MFs react to the REIT allocations. But in the long term, I think it's definitely positive.
Long term, surely positive. Short term, we'll have to watch out for what happens to hybrid and debt. Sandipan as well as Nirav, good afternoon. Nirav, what's your thought coming in on this front as well, right? This reclassification long term, surely a positive. But overall, in terms of exposure now, are there already enough funds that come in? Or equity side, do they have enough exposure? I think Sandipan was, right now saying that there are very little percent in terms of AUM that actually comes in here. So how do you see that moving as well? And do you think that we could see more investments now coming in for REITs from mutual funds versus what we could see in terms of real estate currently, what they are doing right now?
Right. So, Vinnii, a couple of things here. One, of course, the mutual fund industry's exposure is pretty limited to REITs and InvITs as we speak. And there's a reason beyond, of course, the most obvious ones that were shared. I'll just top it up with a few market side or supply side reasons. One is there are only a handful of REITs that are publicly listed, right? So the investable universe itself is not very broad. And now even within these handful, 5, 6 odd REITs that are available for, that is publicly listed and is investable, if you look at the average daily volumes that are traded into these, it's pretty low. In fact, it is in a couple of tens of crores, not even hundreds, right? Mid hundreds types of crores. So there's not enough depth as well as breadth on the REIT side. InvITs, if you look at the list, there could be around 18, 20 odd InvITs, but at least 8 to 10 of them are non-traded, right? There's no trading activity happening. So most of the trading is concentrated in the top 3. So you need to see also as mutual funds try and gain exposures, they cannot find themselves in a liquidity trap, right? They also need to be very conscious of the liquidity that is available, especially with open-ended funds having a fiduciary to process redemptions within a certain timeline. So they cannot have a lot of exposure in relatively illiquid counters that REITs and InvITs are right now. And that's also another supply side reason for why exposure is sub 1% as we speak. However, the segment is growing at quite some pace. It was mentioned somewhere at the start that REITs were not looked at very favorably over the past couple of years because it is more dividend yielding in nature. And I also am aligned with it because over the past 5 years, we have seen a lot of favor moving in terms of growth assets. But if markets remain choppy and the supply side depth increases, and with new listings already moving into the pipeline, we could see the interest really pick pace into this segment, especially as a defensive play within equity portfolios, right? That's for REITs, and InvITs will continue to become strong yielding assets, especially along with the cap rate compression as we move ahead and the interest rate situation progresses in line with the wider anticipation. We could see the yields really look good on InvITs as well. So there is a solid case to be built around it, but none of this is happening overnight. It is a structural shift that will take longer. And you briefly spoke about realty stocks. Yes, mutual funds are taking exposure to realty stocks, but I wouldn't put it in the same line or talk about both of them in the same breath because it is not really comparable as assets. Both of them have different features as well as different different asset values that they are trying to replicate. So realty stocks are being purchased for the business, whereas REITs are for their yields and their cap appreciation.
Yeah, we get that because REITs have underlying as the commercial assets, while we have realty stocks, they have a mixture of a lot of things, be it housing or commercial assets and other aspects as well. Sandipan, let me come to you. We mentioned that specialized investment funds can also see that exposure come by. But there are very few products which have been introduced. How do you see the initial response? Has it been good? Is this a category which would be of investor interest or only a handful of investors, so to say?
As we speak, the first SIF in India has got launched. The NFO is going on from Quant AMC. And there are a few more in the line. I think SBI will follow very soon, and then Edelweiss will come. The thing is, I think it's an emerging asset class. SEBI took a very, very, I would say, radical view on this entire asset class. I think this is the first time where a hedge fund kind of a structure will have a tax incentive of a mutual fund. So creates a huge win-win for investors. and the fund managers, because both of them, for the investors, it's tax efficient. For fund managers, they get a lot more flexibility and maneuverability. How this asset class will pan out, the proof of the pudding in the end will lie in the returns. So while early adopters are already showing a lot of interest, and generally the risk takers, which typically would be the UHNI class, the ultra HNI and the high net worth individual class, they are showing a lot of interest in this asset class. And they would be the first to come into this segment. And then, we'll have a wider participation is how I see it. I think a lot of onus will lie on the advisors now because it's a complex asset class, all said and done. And how we position it, how we, dissect the risks behind each of these strategies, that, will actually set the pace for the investor experience in this asset class.
Right. Surely that is something, an interesting asset class that's coming in up, as well as a lot of interest that's picking up there as well. But Nirav, coming to you, now the SEBI has also revived incentives for B30 mutual fund distributors. There is a cap as well. What does this actually mean, and how are we looking at this now?
So it is not the first time, even before it was taken out of picture, there were incentives in place for B30 distribution. But now it has made its comeback, in SEBI scheme of things. So one very good thing is there's definitely incentive to improve market expansion and penetration. But the second order effect, which is slightly more healthy, is that this is a very good incentive to bring new distributors into the fold. So the enablement is not just for existing distributors, but also to get more distributors into the fold. So if you see that, the 1% cap or the cap up to, a maximum of rupees 2,000 may not mean much to large established players who have been penetrating into B30 markets, but it is a significant incentive for new and the emerging class of distributors to take this role on and further perpetuate distribution. So one important thing that will happen from here is that the distribution segment will get more democratized. We will have more distributors. This ensures that interests will continue to be aligned with the interests because as with the clients, because as the industry expands and more participants expand, the healthy friction ensures that everyone finally coincides and lands up thinking about what's best for the client. So this is healthy for the distribution environment as much as it is for the end clients as well.
Okay, take that point, gentlemen. But this is about the recent amendments, of course, that have come by in through SEBI Meet. But we'll take a quick break. On the other side, we'll focus on the underperformance that has come by in some of these mid-cap funds. We'll discuss the reasons and the outlook going forward. Stay tuned for that.
Welcome back to MF Corner on CNBC TV18. Now we're going to shift focus and talk about mid-caps. Most of the mid-cap stocks have been experiencing significant underperformance compared to large cap. Now, economic uncertainty and inflationary pressures have only added to the strain, making it harder for mid-caps to maintain their momentum. Will mid-caps actually now make a comeback? Are small caps better placed than mid-caps? To answer all these, we still have with us Sandipan Roy of Motilal Oswal Private Wealth, as well as Nirav Arkarkera of Wisdom. Gentlemen, let's start by talking about the mid-cap issues that have come in, right? Most of these mid-caps are underperforming the benchmark indices. Now, but the flows have improved. What is the reason for the underperformance? Sandipan, let me start with you.
Yeah. See, okay, let me put it this way, that the underperformance that we're talking about versus the benchmark is at a more, 3-year and above period. If we look at the last 1 year, 2 years, I think the median mid-cap fund would have actually outperformed the benchmark, which is a very, very good outcome. When 60% or 50%, actually almost 60% of the mid-cap funds have been outperforming the benchmark on a 1 year, 2 year basis. When the picture, we look at it from a 3-year perspective, I think it just changes. Only about 25-30% of the mid-cap funds are actually outperforming their benchmark. I think the reasons can be traced back to a few, structural as well as market-driven reasons. The biggest reason, I think, see, unlike in large cap, where a lot of the growth actually happened in the underrepresented part of the index, in mid-cap, the EPS growth of the index itself was very high. So to have an active allocation beyond the index and try and outperforming the index was becoming very difficult. This I'm talking from a more 3-year, 4-year perspective, or the post-COVID era. And there, I think the index itself has seen a very, very handsome EPS growth. I think almost 27% kind of a growth. So there, I think it becomes difficult for any active fund manager who would look beyond the index to find such stock ideas on a consistent basis. Also, the thing is that fund managers tend to underperform when either the index performance is limited to very few stocks. If you remember the famous period of 2018-19 when there was a Ritik stock phenomena going on in the large cap space, practically everyone underperformed. Or if it becomes extremely broad-based, when even low-quality stocks, low liquidity stocks, everything rallies, and it becomes very difficult for a fund manager for right reasons that he can't really want to expose himself to too many low-quality stocks or illiquid stocks, etc., start to underperform. In this case, I think it was more broad-based performance. And there, more than 50% of the index stocks outperformed the index itself. And that, broad-based the rally, made it very difficult for the fund manager to emulate the same given the liquidity constraints, the quality constraints that I spoke about. Also, fund sizes kept on growing as the market kept on rallying, and it became incrementally difficult to deploy, for the fund managers at the right valuations, I would say. And these become the main reasons, I would say, that over a 3-year period we see it. Now, when the markets normalize, when you see a correction happening, then steady state, some bit of consolidation, and then a rally, I think the fund managers tend to come back strongly.
That's right.
Which is what is happening now.
Yes, and the size that you mentioned, the size is becoming bigger and the opportunities are becoming lesser, right? So where to put in that money, because not everything will outperform in this market. Nirav, your take on this, and do you think it'll be sometime before the mid-cap category sees that outperformance come back? And, we see, of course, flows are coming back, but do you think we'll see that surge in returns as well?
Yeah, so with the mid caps, there are a couple of nuanced variables at play here, right? We all know about the infamous FII exodus, but we fail to recognize that a lot of these ownerships were into mid cap stocks. So there is some impact of an exodus of this quantum happening into counters with such limited free float, right? So that's one. Second, from a valuation perspective, of course, there's this entire narrative about the valuation fraud being created, especially in context of global uncertainties and whatnot, right? In context of global macro. So amidst all of this, there has been a flight to safety. Although there is a tepid risk on environment, there has been a flight to margin of safety rather towards large caps in the past. And some of these factors have been bearing heavily on mid caps so far. However, if you look at the turnaround in the past quarter of earnings, right, you will see that it is almost as if they have crossed a certain junction, a certain crossroad, where you see large caps have been fairly stable, but mid caps has started showing green signs of promise earnings. So there were more earnings surprises on the upside than it were on the downside. In fact, the PAT growth, year-over-year PAT growth, if you look at the last quarter's earnings, has been significantly reassuring. So while, of course, mid-caps remain a highly selective bunch of stocks wherein bottom-up needs to be the approach, it is not wise to paint all with the same brush. It is definitely looking like mid-caps have started turning around the corner. And the next round of re-rating that will happen on the upside will be primarily led due to an earnings revival, even before it is fueled by liquidity. So yes, from here on, the outlook for mid-caps starts looking positive, and we expect earnings to lead this positive sentiment.
Sandipan, coming to you, do you think now that small caps are maybe better placed versus mid-cap currently? What is your thought on this one?
Yeah, so again, very difficult to pinpoint because ultimately it becomes stock specific, but at a broader index level, as Nirav was also saying, I think if you see last quarter's results, let's just point there. So mid-cap PAT growth was about 17% YOY. The top line growth was 12%. Even EBITDA margins grew by almost 110 basis points. Cut to small caps, I think the PAT growth was only about 6%. Okay, revenue growth was 5%. Margins actually contracted by 40 basis points. Okay, so if I look at pure fundamentals performance, this YOY performance of Q1 FY26, I think mid caps look to be better placed. Even from our forward EPS projections, growth probabilities, I think mid caps are slightly better positioned than small caps at an aggregate level, I'm saying. And also, again, since the FII flows bit came up, we saw what happens when the FII outflows happened. As and when the FII flows resume back in India, I know about $15 billion has gone out this year already, but let's say the tariffs get resolved, etc., and FII flows come back, that bit of buying, incremental buying, will again happen in mid caps. So for the same reason, from a liquidity perspective, why mid caps went down can also become a very positive stimulus on the mid caps as a category, even more than small caps, because the large amount of buying will happen in large caps and in the larger mid caps.
All right. Thank you for that. Neera, quickly, if you can tell us, so we have like a minute left for the show. What is your take on small caps versus mid caps now?
So clearly, mid caps are better positioned. Small caps are trading at a very steep valuation, much higher than their long-term averages, 45 to 50%. Mid caps slightly more comfortable, relatively 10 to 15%. Selective opportunities available far and wide if you look close enough. So if you have to take a bet, mid caps over small caps, clear.
All right. Okay, gentlemen, thank you so much for joining in and talking to us about a whole host of things, be it the recent changes that came in the SEBI board meet, or be it the outperformance, the underperformance that mutual funds have seen versus the benchmarks. It really helped and gave perspective for our viewers as well. But with that, we'll do one thing. We'll take your leave on this edition of MF Corner today, but stay tuned. Closing bell will come up next to take you through the last hour of trade.